What's good, family? If you're watching this video, you're either a business owner, aspiring entrepreneur, or someone who's looking to obtain maximum credit in 2026. And if you're tired of playing small and you want to play big, you landed on the right video that is going to expedite your process for you. I'm Dub Washington, and I do two things. Number one, I ensure that everybody eats. And secondly, I make the banks compete to lend you money. Yes, you heard that correctly. I make the banks compete to lend you money. And with the strategies and techniques that I've taught thousands and thousands of entrepreneurs, we have probably been able to amass over, I would probably say, 20 to $30 million in funding collectively across my community. And this is just off of my free content. But anyway, I want to bless you with a in-depth teaching or in-depth masterclass to help you get there in 2026 completely free, right? Remember, I told y'all one of my goals was to ensure that everybody eats. And at the end of this video, you will know how to make the banks compete to lend you money. But before we jump in, we must understand that the lending climate has changed from 2021 until now. Things that worked 4 years ago, to be honest with you, things that worked last year is no longer applicable in today's economy. And it's simply because banks are switching up their internal algorithms. They're switching up risk exposures. They're switching up a lot of things simply because we ran off on them too much. We ran off on the banks multiple times, and the default rate is increasingly high over the past 36 months. So what happens? The job of an underwriter is to mitigate risk. And what they're doing in 2026 are chopping limits. They're closing accounts if you're not actively using them. It's a multitude of things that they're doing to ensure that they're getting the right customer. Are you the right customer that these banks are looking to partner with to either make money off of you or grow your business? So we must look at banking in a totally different light coming in 2026. So if your strategy starts with credit builders, or if your strategy starts with authorized users, these things no longer work. Authorized users are great for boosting age. Credit builders are good for getting you a high credit score. But banks lend off of borrowing behavior. Banks lend off of what you can show them that you can handle. If you have a $50,000 primary on your profile, yes, it looks good on paper, but what's the recent high balance? Are you truly maximizing this credit card to its full potential, or do you have it as a placeholder just to make your account look good? One of the things that I teach my mentees and my community is to understand we operate differently than the rest of the industry. We don't do the things that they do and expect different results. So make sure as you are going through and you're understanding all of this, that it is very, very important that banks are basing their limits off of predictability. They're predicting what you are going to do over the next 3, 6, and 12 months. And with AI, artificial intelligence, being implemented into the banking sector at an alarming rate, they're able to pretty much be spot on whenever you're going to default on credit cards, whenever you're going to carry a balance, based on the data that they have been gathering on you from your checking accounts, from your credit card statements, so on and so forth. They know you better than you know yourself. And whenever you implement AI into that, you must understand, when should I apply for certain credit cards? Is it during a high risk, quote unquote, season for me? Or is it during a time frame to where we are properly building and we're carrying low balances and we're maximizing the credit cards and paying them off in full, and we are pretty much dictating what data is aggregated for us? So I know that was a lot. If you are relying on strategies and techniques that applied in 2021 up until 2025, you are already outdated. Another thing that people don't understand is that information has a lagging indicator behind it, right? So the information that we're getting access to real time is typically 2 to 3 years behind the banking sector. So things that are rolling out now, and we're just now hearing it as a consumer, has already been discussed in these major boardrooms, and they have already been integrated into underwriting policies and a multitude of different things. But let's jump into it, family. Let's clear up the biggest misunderstanding. Credit is not money, credit is access, right? Credit is trust, credit is permission. With all of this being said, what are you doing with access? What are you doing with permission? What are you doing with trust? We're building out internals with multiple different institutions because the name of the game should be to build out a bulletproof profile to where we can walk into an institution and request any amount of money. Now, I know you may be thinking, Dub, there's no way I can walk into an institution and request any amount. But why not whenever credit is made up? Credit is literally a set of numbers that they throw on the screen, and applications and approvals. All of these things are numbers that is literally made up out of nothing. They're not literally giving you $100,000. They're granting you access. So I want to give you an in-depth understanding of how credit is, how credit works, before we really dive deep into the personal credit and a multitude of other factors. But you understanding this part will greatly benefit you throughout 2026. So once you understand how to build up the profile and then you get granted access to 100,000, it doesn't become real money until you use it for something and then you pay it back. So we are creating the circulation of money in the economy. So they are creating the money in a sense, allowing us to have access to, and then we're making it real. So credit is nothing more than made up numbers. So whenever you understand this part, you understand that there is a game inside of a game that you get leverage to get the access. And that's what the goal is for 2026. It is access, right? That's why some people can walk into a bank and get $250,000 and another person with a very similar credit score gets denied. Because remember, family, it is based on predictability. What does your predictive behavior say about you, whether from the past 6 months or in the upcoming 6 months for you? So one of the things that we do is build out deposits. Now, you previously heard me say that your credit score is your GPA. It's nothing more. It is your adult report card. It says what you have previously done, and it's a predictive indicator of what you're going to do in the future. So write this down. Score opens the door while your profile and behavior decides the limit. So your score gets you in the room, but your profile and your behavior determines how you are treated when you get in the room. It's not enough just to be in the room. We got to make sure that we are leveraging the availability, leveraging the access, leveraging the resources to get to the hidden door that you may or may not see. And that hidden door is, let's just say, $1 million plus in credit, $2 million in credit. What could you do with $1 million in credit? Let me know in the chat. Let me know in the comments. What could you do with access to $1 million? And let's just take it a step further and say at 0% interest for a year. You should be able to do that by the end of this masterclass, all from structuring the deposit relationships. In 2026, it's going to be 3 layers: score, profile, behavior, right? Remember, score opens the door, profile and behavior determines the limit. Most people get stuck at level 1. And while it may get you in the door, what are you going to do with it? 800 credit score means nothing if you don't know how to properly leverage it. Is it a screenshot for you? Is it bragging rights for you? Is it a celebration for you? But the 800 credit score is only a snapshot of the internals. So your profile is how old are your accounts, the mix of your accounts, how you manage these accounts, and how stable your activity is. I cannot speak on the importance of payment trends on your credit card accounts because they tell the true story of how you leverage credit. You must understand that if you have a $50,000, $75,000 credit card and the recent high balance is only $500, you're not leveraging what's available to you. Now, let's talk about when nobody on social media is breaking down, and that's internal bank scoring, right? Internal bank scoring is very, very important. Like, how does the money flow through your accounts? All right. How does the money flow through your accounts? What story is it telling? How consistent is it? How many products do you have with this particular institution? How long have you been with that institution? What's your total exposure with that institution and other institutions? All of this dictates how other lenders view you. Even on the business side, most people miss this part here, is that whenever you go in and you move your personal credit over to your business credit, essentially what happens is your business credit utilization goes up. And what nobody talks about on the internet is business credit utilization. If your business credit utilization is at 80 to 90%, you are deemed high risk whenever the banks pull your business credit, because whenever we apply for business credit cards, business lines of credit, they're not only pulling our TransUnion, Experian, or Equifax, they're also pulling the business credit bureaus, which is the SBFE, the Experian IntelliScore, the Equifax Risk Failure Score, the Equifax High Risk Score. So it's a multitude of factors that these banks are going to pull to determine if you are the right candidate to receive this $50,000 or $100,000 limit. Now, let's explain some exposure tolerances clearly. Exposure tolerance is basically the bank saying, how much money are we comfortable having out with you considering what we know about you? No bank wants to be the first bank to give you access to your first $150,000. That is very much a high risk behavior that only a few of us are able to ever go out and experience, because it's an exposure, a maximum exposure based on the relationship that you have with them. So you hit the ceiling for that bank, and you understanding when to apply and what amount to apply for greatly benefits you. Now, let's just use this as a mini case study. Two people have a 740. Person A has no deposits and no relationship, and they just applied. Person B has weekly deposits, they use their account, and they have multiple products with the institution already. Person A may get a $5,000 or $10,000 approval, similar to, other people with high limit credit scores, but person B may get $50,000 immediately solely because the bank understands them already. And then the limit will increase later without asking, all because the bank understands you. They understand you better than you understand yourself. So with all of this being said, you now understand why approvals feel random to people who don't understand banks. They're walking in with a high credit score and they are expecting to receive a high limit. That doesn't always equate to one another. So the moral of the story here, family, and that we must understand in 2026 is that we are building staying power, we are building longevity, and we are, most importantly, building increased consistent deposits, because the banks operate off fractional reserve lending, which states that they're lending my money to you, they're lending your money to someone else, they're lending money from someone else to another person, and they're charging a spread. So everything in the banking sector is solely dependent upon the consumer. So the more deposits that we have go into that institution, the more they're able to lend out. And then the more that they're able to charge on spreads. And the more money that they make off of your money, the more they're going to bless you. Now, with all of that being said, family, personal credit matters because most business approvals still underwrite you personally. So you could be going in for a business credit card, yet they are basing it off of the strength of your personal credit. So the foundation, which is your personal credit, let's equate that to the concrete. That is the foundation. That is where everything is going to start and go from. So your personal credit, just as a quick recap, 100% payment history, utilization anywhere from 6 to 9%. Most people will tell you that you need to have the utilization as low as possible, but whenever you get into having $200,000, $300,000 in available credit, you showing 0% utilization often equates to you getting denied due to having access to too much credit, if that makes sense. So if you have access, like I say, to multiple hundreds of thousands of dollars, anywhere from 6 to 9%, showing the banks that you use it will be of a greater benefit to you than actually showing no balances at all. Now, some deep points to cover real quick is increase sensitive versus relationship banks. Relationship banks are very, very important because, as I previously stated, family, relationship and borrowing behavior, staying power, all of this goes into the same exact bucket to where the bank understands you more. A bank could be inquiry sensitive, but if you have a stronger relationship with them, certain rules and exposures go out of the window. So your relationship is very, very important. The reason why I was able to bypass relationship rules and max exposure rules is because they understood me. So them understanding you and how your business flows and operates is going to be of benefit to you. Revolving utilization versus reporting dates. Very, very important. Most people miss out on this. They have a revolving utilization issue because they don't know when to pay the credit card down. Now, I'm not telling you to carry high balances on your credit cards and never pay it off in full. But what I am telling you is that whenever you understand when the banks are going to report certain information, you're able to liquidate money off credit cards to hide this particular high utilization. Or if you are struggling with getting approvals due to account behavior, recent high balances, a multitude of things. With you having multiple credit cards, we can liquidate to hide utilization. So let's just say that you had two different credit cards. Both of them have a $10,000 limit. You make one payment due date on the 1st. You make the second card's payment due date on the 15th or 16th. If you max out one of these credit cards, you can now liquidate from the other card to pay it down on the statement close date, and it's going to show a 0% utilization. And then before the card 2 reports, you're now liquidating the money off of card 1 to pay down card 2. Meanwhile, the $10,000 that you have on a real estate deal or is put into growing your brand or marketing, whatever the case is, you're able to hide that utilization while the money is truly working for you. So certain things we must understand on, like I say, how to build with these institutions without over leveraging ourselves. Now, authorized users, we talked about this so many times, but I gotta add a little bit more insight on it. If you get access to an authorized user account, someone adds you on their particular credit card, and you're not putting spend on that credit card, what is that really saying? You're not building with that institution because you're not putting any spending power. You're not putting any spending behavior on this particular credit card account. So now what happens is, they don't have any data to judge you off of. One of the best ways for you to build out with an institution that you currently don't have any accounts with is having someone that you know add you on their account as an authorized user, and you being responsible with the authorized user account, even if it's only a $500 spending power, even if it's only $1,000. You leveraging what's available to you will greatly benefit you, family, before applying for brand new products with that institution. Now, one of my pet peeves is whenever someone has credit builders on their profile and they think they deserve 100,000 or even 50,000 because they have a high credit score with credit builders. This does not equate to fundability. Quality of accounts are very, very important, not the quantity. I much rather you have a $10,000 Discover card versus a $100,000 upgrade card or a $100,000 Upstart card. We want quality, not quantity. So as you go into 2026, family, please, please understand strategy. Strategy is the key to getting us to those scalable limits, right? And you can't get scalable limits with credit builders on your profile. Now, as we transition from a quick summary of personal credit building, now let's get to the business side. SBFE reporting. These are quality accounts that is being reported on behalf of your business. If you don't have any SBFE accounts, but you have net 30 accounts, this does not equate to fundability. The same way that credit builders on the personal side does not equate to fundability. So net 30s on the business side does not equate to fundability, and we must understand that. The difference between consumer utilization and business reporting is very, very key. Now, business utilization is not as impactful as credit utilization on the personal side. Personal credit utilization is the second most important factor. Payment history or payment percentage is number one, and then the balance or the utilization is number two. But on the business side, the reason why we get access to capital is so we can use it. So make sure you're using it and leverage these recent high balances, but only during the 0% APR phase. The moment that the 0% APR phase is ending, we don't want to pay any interest. So we want to make sure that we are in proper position by building other banking relationships, that the moment that this 0% APR ends, we have the next bank that we have already been nurturing and sequencing to then be able to liquidate from that particular set of business credit cards or business credit card to pay down the credit cards or credit card that is currently about to expire on that 0% APR phase. Now, what is a promo APR strategy? The promo APR strategy is whenever we are strategically applying for long APR periods. I typically like to have anywhere from 12 to 18 months, but 12 months is perfectly fine. 18 months being on the latter side, but 0% interest for 12 months can put you in so much position. How most people use 0% APR is to take the money off the card or spend the money, and then they're putting it into an investment vehicle, hoping that it returns positive ROI. Well, what we do on this channel is we leverage a portion of the 0% APR cycle to go and build other banking relationships. So what that looks like is me getting access to a 0% APR business credit card for 12 months. Me then taking the first 3 months of that 0% APR to structure other banking relationships. And guess what? The 3 months that I took to build out a relationship with Bank of America, Wells Fargo, PNC, right? Any particular set of banks and or credit unions. And then those 3 months has bought me access to an additional 12 months. So with all of that being said, family, understanding how to properly leverage it. I often ask people, whenever you are going in and applying for your 0% APR phases, what do you do with the capital once you get it? Most people invest in real estate, invest in stocks, invest into a coach and mentor. And all of these things are great, family, if it goes right. But the moment that it goes wrong, and then you use all of your 0% APR and that 0% APR phase is about to end, what do you do from here to position yourself for your next funding round? Because the last thing that you want to do is be fighting against interest payments. Now, deposits equals collateral. Frequency and predictability, deposit velocity, matching cash movement to your industry, training the bank model, and auditioning for capital. So these are some of the points I'm about to discuss now, with the first one being frequency and predictability. How frequently are you making deposits? Are you predictable? Are you doing, once again, the increased consistent deposit inflow? Or are some months you're having more expenses than income? That's a major red flag for a lot of these institutions. Deposit velocity. How frequently are you doing it, right? Frequency. Matching cash movement to your industry. A lot of people do not understand this part. Your industry standards based on the average revenue is depicted upon your NAICS code. So if you go in and you are making $10,000, $20,000, $30,000 a month, but the average for your industry or NAICS code 541611 or 541613, the average revenue for that particular industry may be $600,000, for example. They're measuring you up against what could be. So making sure that your NAICS code is not on the high risk industry, or making sure that it's not recently been under scrutiny for defaults, is very, very key. All we're doing, family, like I previously stated, is just training the bank. We're building out staying power, borrowing behavior to position us to get access to larger limits. Month 1 through 3. The first 90 days tells a lot about you, and that's often whenever we go in and apply for personal credit cards and or business credit cards after a 90-day relationship. Now, family, I drop a lot of this information in my school community. I have a $99 school community right now currently that you can get in and cancel anytime. And I break down in depth a lot of these strategies to help you get access to more funding, particularly 0% APR funding. Therefore, we can travel hack, we can build other banking relationships, we can grow our personal brands, we can grow our businesses. All of these are very, very important. Think about this. Imagine you having access to certain information, but you don't have the right vehicle to get you to where you're trying to go. Are you investing into the wrong vehicles to get you to where you're trying to go? So, as we close out today, family, I just wanted to come through, bless you with information that you could apply to you in your funding journey in 2026 to get you ahead of the curve. If you have not joined the school community, my lifetime mentorship, all links that can be in the description. Like I say, family, I do two things. First and foremost, I make the banks compete to lend you money. Secondly, I ensure that everybody eats. And listen, family, let me know what other credit topics that you are interested in me bringing to the channel. Open Q&A, and I got a lot of different things that is going to be rolling out through the first quarter of 2026. But listen, family, as always, Dub Washington, in my words, everybody eats. I'll see you on the next one. Peace.